Okay, in this recording, we will finish the lecture started in class on Wednesday. For my 8 o'clock class, we actually had gone through 6 of the 8 transactions. We were looking at the item on September 15, performed services on account for $6,200, and we had identified the company received an account receivable and gave up service revenue. We put those into the horizontal model. Service revenue increases retained earnings. That makes it a credit. Whereas on the other side, we received accounts receivable. That's an asset, making it a debit. So let's go to our journal and make that entry. So that was September 15. Oh, I have it in black. And so we have a debit to accounts receivable. Just going to abbreviate it REC. That increased assets, $6,200. So a debit to accounts receivable to increase asset, and a credit to service revenue because we provided services. When you provide goods and services, that's revenue. Revenue increases retained earnings. Okay, there's our debit and credit. Let's go post those to our ledger. So we go over to the ledger, we write our date, we have our debit to accounts receivable, we go over to service revenue, and post our credit. So copying the numbers over is called posting. So we have a debit to accounts receivable, a credit to service revenue. Okay, let's go back to our transactions. Let's look at September 20th. On September 20th, the company paid a cash dividend. Now, dividends are a little awkward. We know that we give up cash. It's not as if the company actually received something, but it does represent a distribution of earnings, and that's called a dividend. So let's do the cash one first, because that's always the easy one. Cash is an asset, right? So under assets, we list cash going down. Dividends, we're going to put under retained earnings. It caused retained earnings to go down. So we're going to have an entry for dividends, causing retained earnings to go down eventually, and cash goes down. Let's identify debits and credits. We know that assets go up with debits. And on the other side, liabilities and stockholders' equity, this is supposed to be an equal sign, those go up with credits. And then just the opposite. Assets go down with debits. The other side, assets go down with credits. I said that wrong. And the other side goes down with debits. So there's your debit credit rules. So we have a decrease in an asset. That makes that a credit. So we're going to credit cash. Retained earnings goes down. So dividends are debits. So we will debit dividends directly. We don't actually take it to retained earnings. We'll debit a dividend account, which will have the impact eventually of reducing retained earnings, and we'll credit cash. So let's go to our journal and make that entry. So on September 20th, we will debit the dividends account. That causes retained earnings to go down. And we will credit cash, causing assets to go down. So we have the left-hand side of the balance sheet equation going down and the right-hand side of the balance sheet equation going down. And that was for $700. And then we go and post our debit to dividends, our credit to cash. We go from the journal to the ledger. So on September 20th, we have a debit to dividends of $700. We post that. We go up to cash. Under the credit side, we list the $700 on September 20th. So debit dividends, credit cash. Okay, very last transaction. We received $600 from the customer billed on September 15. So back here on September 15, remember that's when we received this accounts receivable. So what do we receive? Well, we're going to collect cash from that customer. And what do we give up? Well, we already provided services, right? This is a carpet cleaning company, so we've already cleaned this customer's carpet. So we're not giving that up again because we already provided those services back here in this transaction. Instead, where the account receivable went up, we're giving up some of that account receivable. I'm just going to abbreviate it there, but it is an account receivable. Okay, let's start with the cash. So let's kind of mark that off. Cash is going up. That's an asset. And the account receivable, that also is an asset, going down. So we have an asset exchange. We receive cash in exchange for customer's account receivable. Secondly, apply your debit credit. These are both assets. The one going up is the debit. The one going down is going to be assigned the credit. So we're debiting cash, crediting accounts receivable for $5,000. So we go to our journal, and on September 30th, we debit cash. Cash debits are always listed first. So we debit cash for $5,000. And then our credit account will be accounts receivable. And I'm just going to abbreviate that REC, assets going down. So debit cash, credit accounts receivable. The debit causes assets to go up, the credit causes assets to go down. And then let's go post that in the ledger. So we had a debit to cash on September 30th. So go to the debit side, list that $5,000. And then we'll go to accounts receivable on the credit side, list or post that $5,000. So we posted a debit of $5,000 and a credit of $5,000. Okay, so we have journalized, we've analyzed all of these transactions in terms of the horizontal model, debits and credits, and then we put it into the accounting system. The first step is to record it in the journal, and then second step is to post all these in the ledger. Then we're going to tally balances. So I'm going to draw a line here, and for assets, debits are positive numbers, credits are negative numbers. So I'm going to pull out my calculator. I'm going to enter in 20,000 plus 5,000. Then when I go to the credit side, they're going to be negatives. So then I'm going to subtract 1,000, subtract 10,000, subtract 1,200, subtract 700. And I will end up with a positive number. Since it's a positive number, I put it on the debit side. So I'll have a balance of 12,100. And I'm just going to write BAL representing balance, 12,100. Let's go to accounts receivable and do the same thing. The debit is a positive number. The credit is a negative number for assets. So I'll take 6,200 minus 5,000. That's a positive 1,200 that goes on the debit side. Prepaid insurance, I can do the same thing. There aren't any credits, so really 1,200 minus 0 is a balance of 1,200. And then lastly, equipment, the same thing. 12,000 minus 0 gives me a balance of $12,000. Now, when we go over to the other side, credits are the positives this time. So for accounts payable, I'll draw my line. 200 is a positive number. There's nothing on the negative side. So the balance for accounts payable is $200. Likewise for notes payable. The credit is a positive number, so I'll just bring it down. That's also going to be its balance of $15,000. Try to squeeze this in. Common stock, $20,000 credit balance. There's nothing in retained earnings, no debits or credits. Service revenue, there was only one item, so that $6,200 credit is the balance. And I can do the same thing for rent expense. Bring down the $1,000 as its debit balance. Same thing for advertising. That 200 is its debit balance, and the same thing with dividends. That $700 debit is the balance. Okay, now we need to make sure that we're still in balance, right? We want to make sure the debits equal credits. So we're going to create a trial balance. A trial balance, we're going to list balances. So I'm going to go to cash, and I'm going to look at the ending balance, $12,100. I'm going to put that in here as its ending balance. And then I'll do the same for all the other assets. So I'm going to list accounts receivable, $1,200, prepaid insurance, $1,200, and equipment, $25,000. So 1,200, 1,200, 25,000. And then we move over to the credit side, because accounts payable will have a credit balance. So the accounts payable, I'll list its credit balance of 200. Notes payable, its credit balance of 2,000. So enter those in. 200, 15,000. Oop, wrong way. And then common stock, 20,000. Nothing for retained earnings. So I didn't even have retained earnings listed here. Okay, then service revenue has a credit of $6,200. And then we're back to our expenses. I see I made a mistake. Instead of total, we need to have dividends here. So if you want to squeeze that account in, and then we'll do totals. Okay, so I'm going to list the two expenses and the dividend. That's going to be 1,000, 200, and 700. So on the debit side, 1,000, 200, 700. And then, I'm kind of drawing my line here. I'm going to add up all the debits. So sum all the debits. You should get 41,400. And then I'm going to sum or add up all the credits, and I'll also get 41,400. I'll double rule those, because in accounting, the double rule means we're in balance and we're kind of finished. The last thing I'll do, although I will tell you your homework doesn't require it, but let's go through it real quick. The reason you're going to, we stop here, we have the trial balance. We can start with service revenue and put that into the income statement. And then the two expenses, 1,000 and 200, total those up, and we'll have net income of $5,000. Remember, there was no, right, I don't even have a retained earnings on here because it's the beginning balance. And then we will pull in our net income of $5,000, subtotal that to $5,000, list our dividends of $700, and we'll have ending retained earnings of $4,300. And then that $4,300 goes forward to the balance sheet, right? So the ending balance of retained earnings goes forward to the balance sheet. Then I'm going to go up and list my assets. So I'm going to list cash, accounts receivable, prepaid insurance, and equipment. I'll enter those into the financial statements. So 12,100, 1,200, 1,200, and add those up, and I'll have 14,500 for the current assets. Equipment was 25,000. That's the long-term asset. Those total 39,500 for total assets. Then we'll go to liabilities. I'm going to list the 200 and the 15,000. Assuming that 15,000 is short-term. So total current liabilities and total liabilities, 15,200. We need common stock. That's the last account, right? We've listed all the debits, and that'll have us, once I put that 20,000 in, that lists all of those credit accounts. Add up stockholders' equity, 24,300, and I add up liabilities, stockholders' equity, and I get 39,500, and we're in balance, and we're all done.